In order to better understand materiality, let's apply it to an example. First, read the question all the way through. Below is a summary of two income statements. ABC Company, which had sales of $10 million and income from operations of $500,000, and XYZ Company, which had sales of only $1 million and income from operations of $50,000. Both companies, when you divide their income from operations by their sales, have the same income percentage, 5%. Both companies sold equipment during the period, and unfortunately, the accountants for both companies neglected to record the loss on sale of equipment in their income statements. Required: determine if the missing information is material. Remember that materiality in accounting is defined as a quality of being relevant or significant. It speaks to how important a piece of information is. Therefore, information that is material is relevant because it has the capacity to affect the decisions of the stakeholders. Materiality depends not only on the dollar amount of the financial information, but also on the importance of the information. Looking at ABC Company, the loss doesn't appear to be significant. $10,000 when their sales are $10 million and their income from operations is $500,000. It's hard to see because we're looking at an absolute dollar value, $10,000. So it's better to change it into a percentage. Let's take the loss as a percentage of their income from operations. We do that by dividing the loss on the sale by the income from operations, and that is equal to 2%. 2% is not that much. The omission of the loss doesn't really seriously distort the income from operations. In fact, if we include the loss in the income statement as a deduction after income from operations, the income before income taxes would be, let's just try that. We got 500,000, subtract the 10,000 loss, that is equal to 490,000. If we now recalculate the percentage that was calculated before as 5%, we take income before income taxes and we divide it by sales, and we see that it's now equal to 4.9% instead of 5%. That's not a huge difference. Now, let's look at XYZ Company. We'll do the same calculation. What is the relative size of the missing loss on sale when compared to income from operations? We're going to take the loss on the sale, divide it by the income from operations, and we see that this makes up 20%. The omission of this loss appears to be material. If the loss was included in the income statement as a reduction after income from operations, the income before income taxes would be what? 50,000 minus the 10,000, that's equal to 40,000. And the percentage would then be calculated as income before income taxes, 40,000, divided by sales, which are $1 million, 4%. So that means there's been a reduction of 1 full percent. There appears to be a significant and material impact from omitting the loss on sale from the income statement of XYZ Company. This example shows that it is not the absolute dollar amount that indicates materiality, but the item's relative size. Remember, the decision about whether something is material or not is based on professional judgment of the accountant. It is the accountant who determines whether the item is material enough to impact the decision of the stakeholders using the financial statements. Materiality.